Hi guys, this is Vitaly with AFT Dispatch and A2C Logistics, and in today's video, I'd like to speak with you about a very important aspect of the trucking industry. In fact, it's a very important aspect of any business, especially those where you have hefty fees, costs, operating costs, where you have to finance equipment, trucks, trailers, farm equipment, and the like. So that is going to be a big portion of your operating costs. This video is probably one of the most important videos that I have ever done, definitely the most important of this year, and likely to move forward into 2025 and forward. This video will be extremely helpful to all of those of you guys who are looking to get into the industry, all of those who are just entering the industry, are shopping around, trying to figure out what is the best way to get their business going. Remember, this is a down market, and you have to get things done right. However, if done right, you can actually position yourself in a very nice way for the future as the market begins to change and rates begin to increase. So as always, guys, all of our videos, if you have any questions, comments, anything at all, leave your comments in the comment section below. Make sure to like and hit the like button, subscribe, hit the notification bell, all that jazz. Let's kind of move forward. This is super important, and unfortunately, I will say this, unfortunately, this video is probably not going to get a ton of views unless you guys actually share it. But I want you to first watch this video all the way to the end, because I'm going to give you real life examples. I'm going to go very thoroughly through all the information to make sure that you guys understand it and actually see the value and what I'm actually trying to get at. So again, probably not going to get a ton of views because previous videos where they were really info packed and very helpful are not the ones that truckers generally watch, but they should be, because especially the new guys, if you're in information gathering stages of your business, don't cut yourself short. Make sure you get all the right information. Again, questions, comments, leave them down there. Give us a call, text us. All our information, contact info, everything's in the corner there. So this is what we're looking at, guys. This is the bit of a presentation that I created for you guys. Let's get going. Semi-truck financing, talking about specifically interest calculations. Again, watch this video to the very end because we're going to look at some real life examples. Now, what are we talking about? Number one, I'm sorry I have to do this, but this is not financial advice. I am not, not a financial advisor. We are not financial advisors. The content in our YouTube videos, in this video and other videos, is for educational purposes only. It merely cites our own personal opinions, our experiences from the past. In order to make the best financial decision that suits your needs, you must conduct your own research and, if necessary, seek the advice of a licensed financial advisor, not us. Also, remember to make smart decisions and do your own research. So here we go, guys. Get that out of the way. So are you thinking about getting into trucking, just as we talked earlier? Do you need to finance your semi-truck? Do you need to finance a semi-trailer? Do you want to avoid some of the rookie mistakes that are often made, I've made, others have made, and you want to learn from other people's mistakes? So let's look at this in terms of interest calculation. Super important information. Like I said, make sure to hit the like button on this video, and let's get it shared amongst others. Now, there are three primary types of loan interest calculations. You're going to have your simple interest, you're going to have your compound interest, and finally, you're going to have your pre-computed interest. Now, there are other methods and methodologies. These are the primary three that you're going to run into most of the time. These happen to be in the order of, best to worst. So simple interest is your best option, compound interest next, and pre-computed is your last option. Then you have your secret weapon, the principal only payment. I'm going to show you guys how this is going to actually help you out. So let's get the show on the road. So let's start off with simple interest. What are we talking about here? Simple interest. And I promise you, this will all make sense. We'll go over it over and over again. The time you invest in this video is going to be worth it. So simple interest is interest that is calculated based on the outstanding principal. Remember, every payment for a piece of financed equipment or any sort of loan is going to have two parts to it. It's going to have your principal, the original value that you're paying off, and it's going to have your interest, right? So it's principal and interest. So the interest is calculated based on the outstanding principal when looking at simple interest loan calculations or interest calculations. As the principal balance decreases, the interest charged on the remaining balance also decreases. Making an extra monthly principal only payment, specifically principal only payment, directly reduces the principal balance. Okay. Next, we're looking at compound interest. And again, we'll compare and contrast all three. Don't worry, just stick with us. Compound interest is interest that's calculated on the original principal, just like earlier on the simple interest, and on any accumulated interest that hasn't been paid yet. That's the main difference. Interest savings may not be as significant as with simple interest because interest continues to compound on the outstanding balance, which includes unpaid interest. Okay. And finally, an extra monthly principal only payment, just like in a previous example, is beneficial, but the interest continues to accrue on the remaining balance, which again includes any unpaid interest. Okay. So what's going to happen is you have your principal, let's say 150 grand, and then you have your interest. Let's say it's like, 30 grand of interest over the life of the loan. As you pay it down, you make the extra additional payments under simple interest. You're paying that down to principal only. So you're reducing the taxable amount. So over a long period of time, it's going to save you a ton of money. With compound, that also works because it is based on your principal. However, the interest that's on a loan is growing. So the balance is growing and the interest continues to accrue. So you are getting some benefit, but what you're not getting is as much benefit because there is this constant fight of paying this down, reducing the amount, but the interest keeps growing as well. So it's the second best position that you can find yourself in that sense. So let's get back to what we got going on here. So that was compound interest. Now let's go to pre-computed interest. Now pre-computed interest is one of those things, one of those scenarios where what you're generally going to find is if you had bad credit, if you've been rejected for equipment financing, sometimes if you're a brand new company, you have no history, or you're a young company, you have no history, or you have bad credit, etc., you end up with pre-computed interest, which is not a very good way to go, but it is a way to be able to, get started in business. And so it is a tool. Remember, all these things are tools. So you got to make sure you understand the tools. So pre-computed interest is interest that's predetermined and added to the loan amount at the beginning. Okay. Early payments do not typically reduce the amount of interest that you owe. The interest is essentially front loaded and the total interest cost is determined at the outset. Making early payments might reduce the overall loan term, but the total interest paid remains the same. Now let's stop here for a sec. What are we talking about? Let's say you take out $100,000 and, let's say you take out $100,000 and what they're going to say is that, okay, this $100,000 is going to have, let's say $30,000 in interest. So what's going to happen is they're going to say, okay, let's say your payment is $1,000, 700 of that is going towards principal, 300 of that, no matter what you do continuously until the time that you pay off this equipment, this loan, you will have equal parts as agreed at the beginning of, the loan signing, right? So this is where it's difficult because what's happening, and a lot of people make this mistake and they actually go to the loan term and they think that just because they're making an additional payment or in our example, principal only payments, that these things are going to actually help them. But what you're ultimately doing is saying, take my money, here's an extra payment. A bank will say, yeah, great, that's awesome, because the interest rate is the same. It doesn't actually change. It's already predetermined in your payment. So you have to be really careful. At that point, what's the point of throwing money away if it doesn't actually benefit you whatsoever? So let's go ahead and switch back and look through that. And then we'll look at the numbers. But for now, make sure to like and subscribe the video, on our channel. Subscribe, like this video, hit the notification bell. We got a lot of good stuff throughout. There's a lot of content that I'm going to leave in a corner of this channel, of this video, so you can actually click around and watch some other videos that are like this, very similar, or other types of videos that are also very helpful and beneficial for your purposes in the trucking industry. So principal only payment, your superpower, your secret weapon. Let's look at it in terms of simple interest loan, right? We'll look through all three. So again, what is the benefit? The benefit is that in a simple interest loan, you get the most benefit from an extra monthly principal only payment. Keep highlighting that. It has to be principal only. None of that money should go towards interest. You are making sure to instruct your bank, your lender, to accept this extra separate additional payment as part of principal only. Let it reduce your principal. It's not an extra payment. It's not a payment towards interest. None of the money should go towards interest. The money should go towards principal only. This is the secret. And the reason for this is because it directly reduces the principal balance upon which future interest is calculated. Okay. This means that every extra dollar that you put toward the principal saves you money on future interest payments. This is very, very. So same thing, simple interest. What's the reason behind this? The reason is that with each additional payment, you reduce the outstanding balance sooner, leading to a decrease in the amount of interest charged in subsequent periods. This effect continues for the entire loan term. This is where you're using time to your benefit. Now, guys, I want to take a quick moment here. Here's the thing. I know that I'm going over and it seems like it's repetition, and I know that we keep drilling the same point, but again, stick with me. You might know some of this stuff, but I promise you don't know a lot of this stuff. And I will prove to you that a lot of you folks that are saying, there's no money to be saved, Vital, you keep saying save on this and save on that, this, etc., but I can't do this. The market's bad. The rates are terrible. Diesel's expensive. You're right. But yet you're still wrong. I'm going to show you why. So let's jump back in. So guys, over the entire term, you're going to benefit. Now, where's the principal only payment come in on a compound interest loan? And we're talking about the benefits here. Making it is still going to benefit you. Okay. So making these extra $500 payments. So it doesn't have to be $500. I'm just going to refer to it because that's going to be in our example, but making an extra monthly principal only payment still provides a benefit in a compound interest loan, but the impact is somewhat less than in a simple interest loan. The reason is that while the extra payment, it reduces the principal, the interest continues to compound on the remaining balance that's constantly growing. Got to be careful there. The reason again is because the benefits come from reducing the principal faster. You are reducing the principal faster, and this leads to lower interest charges. So that's fantastic. However, the interest continues to accrue on the remaining balance, so you won't save as much in terms of interest compared to a simple interest loan. So this is still a good option, but you got to make sure you know what you're getting into when you're signing documentation and paperwork. So look at the the pre-computed interest loan. So the benefit of this is that in a pre-computed interest loan, the benefit of an extra monthly principal only payment is actually very, very limited, if any. This type of loan typically calculates the interest at the beginning of the loan and adds it to the total loan amount. Extra payments reduce the outstanding balance, but again, they don't significantly affect the predetermined interest amount. And generally, the effect that you could have is going to be in the terms that you may be able to negotiate with the lender themselves. Traditionally, this is not going to benefit, even on a limited basis. Now, the reason for this is that the predetermined interest in a pre-computed interest loan is usually fixed, meaning that you'll pay the interest amount regardless of additional payments. While extra payments reduce the amount or the loan balance and shorten the loan duration, which is good, they won't save you much on the predetermined. So let's take a look, guys. Let's definitely jump in at this point to the pre-computed interest and look at basically that as well as the other two options. So to summarize, in summary, for most significant interest savings and quickest loan payoff, a simple interest loan is the best option when making extra monthly principal only payments. Compound interest loans also provide benefit, but to a lesser extent, while pre-computed interest loans have limited potential for interest savings due to the predetermined interest amount. Guys, thank you for sticking with me. Let's keep going. Next slide. Let's get real, okay? You're buying an expensive piece of equipment. It's a semi-truck, semi-trailer, a piece of farm equipment, whatever it might be. Interest makes a huge difference when working with large numbers. And trucks, trailers, and farm equipment are very large numbers. They're expensive. Now, not understanding interest calculation could cost you time, extra money, and set you up for failure. We have a video about that. The number one reason owner-operators failed to succeed, why they failed in business, was actually poor money management. So I'm trying to help you guys out here, okay? If you need to rewind a video, watch something again, do it. If you need clarification, call, text, leave a comment. I do read them all. I don't always, have the ability to respond, but I do read them all. So do not leave this alone. Not understanding interest calculation will cost you. Don't forget, truck and trailer payments affect insurance rates and your total operating costs. We talk about operating costs all the time. Why not begin with the very biggest number you're going to be starting out your business with and negotiating that to the exact amount that you can possibly get out of any given market, therefore lowering your operating costs, therefore lowering your insurance premiums because the valuation is going to be lower. People skip this all too often. So not you though. You're gonna know exactly what we're doing. So real life example, as promised. Let's do this, guys. What are the loan details? So let me do this, guys. What we're gonna do now is we're going to look at a loan. Everything's going to be exactly the same. I've done my darnest to make sure the numbers are as close as possible to real life figures today in 2023, most likely very similar to 2024. So this stuff will make good sense. There are calculators online. There are different ways to run the numbers, and I'm going to do a realistic dive in. So let's jump in. Back in here, real life example. Here are the loan details. We're taking out a loan for 150 grand. I think for 150 grand, you get a real truck, okay? The interest rate is at 7.5%, which is the going interest rate right about now. The loan term is going to be for 60 months, which is 5 years. We're going to look at an additional monthly principal only payment of $500 from month one all the way to the end of the loan term. And we're going to look at the numbers, the savings, time, everything. And we're also going to do something extra on top. So guys, pardon me, real life example, let's look at only the simple interest. There is no point for us to look at compound or for pre-computed. Just look at the simple interest. Again, $150,000 loan, 7.5% interest for 60 months. We're looking at a monthly payment that's going to be $3,006 under those terms for the next 5 years or 60 months. The total interest that you're going to end up paying without making the additional $500 payment is going to be $30,000, $341.57. 30 grand, $341.57 on a $150,000 original loan. Now, let's say you add the $500. What you're actually going to do is you're going to save, or you're going to pay still $25,092.89. So about 5 grand less in interest, which is $5,240.68 saved in interest payments, 50 to 50 over the term. So that adds up to $104 that you that you didn't throw away, literally $100. Now you might be thinking, oh, what the hell's $100? Vitaly, trucking, we're dealing with huge numbers. I'll show you. And you own asset 10 months sooner. So instead of 60 months, you get it in 50 months. So you save $100 a month, $104 a month, every month for the term of the entire of the loan, and you get your equipment 10 months sooner. Think about it if you're actually growing and what you can do with that time, 10 months, and not throwing money away. Oh, the savings. Is it chump change? Let's take a look. This is my favorite part. So I'm going to switch over again. Guys, here's the thing. This is the most exciting part for me, and this is the same part that's going to generate the most comments for those of you who stuck around. We're going to argue with me till we're all blue in the face. But here's the thing. It doesn't matter. Is it chump change? Let's get going. You have saved $104 a month on a $150,000 truck in truck financing. You did not spend that money on interest. Now I went ahead and added the trailer on there. Say half the price, $75K trailer. That's about $52 $272 saved in interest. All right. Now, let's say you're saving about an average of 15 cents saved on every gallon that you fill up. That is possible in today's market. In fact, it's probable, highly probable, available. Those of you, that are doing it, go out there in the comment section. Tell us, hey, you know what? What are you talking about, Vitaly? I'm saving 20 cents, 25, 30 cents. Tell me what you're saving, because I'm being conservative. And those of you who don't believe me, take a look. I believe I'm being very conservative. 15 cents a gallon, you can do that. Now, let's say you're also saving about only 0.5% on your factoring cost. 0.5% is all I'm asking. Half a point. Totally doable, totally available, totally. Even in today's market with expensive money, you can still do it. Okay, what does that mean? Well, you have saved in a truck and trailer together $1,872 interest. That's annualized. You've saved $3,000 in fuel. Now, the numbers for that would be 10,000 miles a month, running at about 6 miles a gallon. You've saved $3,000 a year in fuel. Okay, you've also saved $1,400 on factoring, considering a $280,000 gross per year, which is totally doable, especially with those miles. So what does that come out to be? $6,272 that you ended up saving that year, okay, per year. $6,272 a year, $6,272. That ends up being $522.67 saved per month, guys. It is money saved per month. Now, I gotta switch over. Here's the thing. You're gonna save $522 a month, but up until this point, most people are like, what's $100, man? Who cares about $100? What about $522? That's money, right? So in turn, you've paid $500, but with all the savings and everything else, you actually gained $522 in savings and got your equipment 10 months earlier. All right, enough said there. Switching back over. 10 months saved, just like I said. Boom. So guys, power of a truck dispatch service. Imagine you saved all that money and you made extra and you had no headaches at all because your dispatchers know what they're doing and they're making money. Yeah, guys, stop haggling. Stop wasting your time. Work with dispatch. We offer truck dispatch service at AFT Dispatch. We offer lease owner operator opportunities for, lease owner operators at A2C Logistics. You guys, more information at aftdispatch.com in fact, don't /, just go to aftdispatch.com. That's all you got to do. Enough said. Call or text us at 801-448-6363. Guys, you don't want to put yourself in a position where you're not saving, where you're not making money, and you're not putting yourself in a position where you could be saving money, making a higher gross. And if you don't believe me, take a look at our playlist, Top Paying Loads in Trucking. Every week at 5:30, we provide you guys this information. Here, let's move this down so you can see my mug. So guys, here's the thing. Every week, every Friday, 5:30, we provide you guys videos of the top guys in our trucking operations, right? Lease non-owner operators, carriers. What kind of money are they making? What kind of money are they making? What kind of money are they bringing home? What's their gross? What's their averages? What kind of miles they're running? We show you guys every week in and week out. For years we've done that. And as you can see, truck dispatch services, owner operated leasing, and even lease purchase programs for highly qualified customers, those are available. And we've been doing this for years. We're here to help you guys out. Every few days we produce some videos. On Fridays we produce our weeklies. We're trying to produce a lot more content for you guys. But again, this video is one of those that you really want to be able to share. And outside of saving money, and again, all those numbers, those are doable. You just have to learn what you're getting into. Don't just go in and finance. Don't just believe those financiers, those bankers, those lenders. Don't just do that. Just because the numbers look pretty, that doesn't mean that it's actually correct the way that they're calculating. A lot of times this might be predetermined interest rates and you're just shooting yourself in the foot. Yeah, you got a truck, but you don't, by the time you get it paid off, it's going to cost you an arm and a leg. You don't want to do that. There are ways of saving money with fuel. There are ways of saving money with factoring. There are ways of saving money on insurance. You're working with brokers with insurance. You're working with basically salespeople with factoring, with salespeople with fuel, and you're working with people who want to make money off of you. So work with the ones that are decent and good people, but also at the same time understand their game so that they can pull a fast one on you. And that's all I'm saying. Yeah, it takes years and it takes a lot of time to be able to get to that point and to be able to actually achieve these types of savings. But again, you can save over $500 a month, and this is at today's rates, 7.5% interest, guys. So this is all doable. Guys, make sure to get in touch with us. Let me see if I can find the right button on here. I think that's the one. There's the number, 801-448-6363. Go to our website at aftdispatch.com. You can also go to our landing pages, get more information about our services. There's just so much that can be accomplished. And, even in today's market, in the meantime, also, give us a call so we can help you make more money. We have a ton of customers who are making more money. Our leasing program is one of the lowest cost programs out there in the nation. Okay. So you don't want to be overpaying for your lease program. At the same time, whether you're a carrier or an owner operator, you want to make sure you're making the top money out of the market that you're in, but also don't leave the savings on the table. It's business. You have to do all those things, and combine all those things to save money and to make this thing a viable option so that you're able to make money in bad markets and make a lot of money in good markets. Guys, enough said. I can talk about this, with no end in sight. I enjoy these topics. I enjoy helping helping you guys out. And as always, I'm going to say it again, questions, comments, anything whatsoever. If did I get something wrong, did I get the numbers wrong? I don't think so. I've double and triple checked everything. So, but anything whatsoever, leave us a comment in the comment section below. Please share this video. I really think that this video is going to be beneficial to a lot of folks out there who are making this common mistake day in, day out, every single day, and people are preying on it. They're not explaining these things, and and people are just overpaying, and ultimately over a long period of time, they're actually hurting their chance of growing fleet, of being able to grow their businesses, be able to actually attain that money for themselves, for their family, for equipment, repairs and things like that. There's a ton of ways you spend 500 extra bucks every month, and they're also shooting themselves in their foot about expanding. So there's a lot of different benefit from doing things correctly. So anyway, guys, until next week, stay healthy, be wealthy. Questions, comments, or concerns, leave them out in the comment below. Hit the like button, smash the subscription button, smash it all, guys. I'll talk to you soon.